So you thinking about your risk capacity, we're thinking about managing the risk appetite. And what is it that we've been doing in our portfolios over the last year? Firstly, let's look at the left-hand side. In the asset allocation portfolios, so the stable fund and the balanced fund, what are the changes that we've made over the past year? If you cast your mind back to a year ago, the Rand had sold off after the first change of finance minister, and the Rand was slowly improving as 2016 progressed. We used that opportunity of a strong Rand to buy additional dollars for the portfolio. So we made additional investments into the Orbis as well as the African portfolios. And you can see that there with the foreign ex-Africa and the Africa excluding SA sections. We funded that by reducing the exposure to South African equities, particularly in the stable fund, where we reduced the hedges that we had in the portfolios to generate the cash to invest in these portfolios. And then the other section includes the likes of commodities and property, where we also reduced the position in both portfolios. The SA fixed interest component, that would be the likes of the money market sections as well as the bonds that we have in the portfolio. And importantly, this moves around a lot from time to time, but importantly, we've reduced the duration of those holdings in both portfolios. So the stable fund sits with a duration just over 1 year, and the balanced portfolio sits with a duration just in excess of 2 years. If you then focus on the right-hand side of this picture, the equity changes that we've made, and this applies to the equity that we hold in all three of these portfolios. We've been buyers, so we've added to our position in healthcare, and I'll unpack that a little bit for you briefly in a minute or so. And we've increased our position in media, predominantly Naspers, over the past year. At the same time, we sold our very large overweight position to the banks and hold a smaller position today. We still have exposure to the South African banks, but the share prices did extremely well during 2016 after selling off a lot in late 2015. So the prospects of the banks have not changed dramatically, but the share prices are a lot higher than what they were a year ago. So we've reduced our exposure there. And then in the general mining sector, we've also reduced our exposure as the commodity prices have improved over the past 18 months. So if we then put this together, this is the asset allocation at the end of April. And again, you can see clearly here the difference in risk appetite between these various funds. So the stable portfolio has got 33% exposure to net equities, the balanced fund at 63%, and then the equity fund essentially fully invested in equities, as that is the name on the sticker. Importantly also, at the bottom, you can see that the offshore or the foreign exposure has continued to be at the maximum allowed limits by the regulator. So the stable and balanced fund both sitting at 27%, and the equity fund now up to 19%. Remember, we changed the rules for the equity fund a few years back, and we're allowed to now build that up to 25%. So we're making good progress in that sense, getting the portfolio up to the maximum exposure. If you then look at the equity position, so that 33, 63, and 94%, if you look into that, what is the actual shares that we have in this portfolio, in these portfolios? And you will see that the names overlap very, very much between these portfolios. So the Sasols, the Naspers, and the British American Tobacco. Companies that we've discussed at these forums with you before, and we continue to think that they hold superior returns for investors and will deliver superior returns over the longer term. I think the other thing that you should note from this list of the top 10 companies is their international flavor or their international mix of revenues, activities, and profits. So these companies are very diversified in their own right, that don't necessarily make all their profits in South Africa. They would benefit from other countries with faster growth rates. They will benefit by earning some of their revenue and profits in dollars, euros, yuans, and the likes. So even though it is a concentrated portfolio, so 10 shares make up 60% of the exposure, these companies are highly diversified in their own right and in their revenue streams.